The European chemical industry is facing a deep and prolonged downturn driven by weak market fundamentals, high input and energy costs, and intense competition from lower cost regions. Over the past 2 years and into 2026, the sector has seen a wave of steam cracker closures and downstream rationalizations with little sign of near term recovery. So far, 6 European steam crackers have been closed and 2 more are scheduled by the end of 2027. Structural oversupply, strained margins, and subdued demand have pushed average operating rates down to around 75% in 2025. Despite announced closures removing nearly 5 million metric tons per year of ethylene capacity, further rationalization is expected as companies continue to review underperforming assets. Europe's competitiveness has eroded, especially compared to the US and Middle East, where ethane based production enjoys lower feedstock and energy costs. This has led to ongoing asset reviews and closures across the region. Globally, demand for cracker feedstocks is projected to rise significantly by 2034, with ethane becoming more dominant in the US and Middle East, and naphtha demand increasing due to new integrated projects in China. However, the worldwide ethylene market remains in a prolonged down cycle after years of capacity overbuilding. A broad market recovery is not expected until at least 2028, when demand growth is forecast to finally outpace new capacity additions. In Europe, ethylene prices and margins are likely to remain under pressure. Weak demand, persistent oversupply, and uncertainty around tariffs continue to dampen market sentiment and delay investment decisions. Looking ahead, the European olefins landscape will depend on deeper capacity rationalization, the impact of new assets such as Ineos's Project 1 in Belgium, and whether structural cost disadvantages can be addressed. Until then, the outlook remains challenging and uncertain.